Bill Bengen, an extremely warm welcome to the Humans versus Retirement podcast.
Dan, thanks for inviting me. I'm really glad to be here.
Bill, do you know what? I'm so thrilled that we have made this happen. We had I think chance encounter over on LinkedIn. I put a video up on LinkedIn about withdrawal rates and how we think about it. Obviously, that is your complete wheelhouse that you've dedicated your career to, and you very kindly responded to that video and offered some advice and everything. And I thought, well, whilst I've got you, Bill, it would be great to have you on the podcast. So we've made this happen, and I can't wait for this conversation because I know you've got so much to offer, and there's going to be so much value coming out of this conversation to the listeners.
Yes, I sure hope I can give you good stuff. I think I've done a lot of research lately, so I've got some new results I'm eager to tell you about.
I can't wait. So look, Bill, your initial research around the 4% withdrawal strategy has gone global in the financial planning world and I know you don't like the term, and I don't like the term either, as the 4% rule.
Uh-huh.
So what I'd love you to do is just kind of maybe take us back a little bit. What made you dig into the research? What the conclusions you come to? Maybe give us an understanding of how you may not have necessarily liked the way that that's been interpreted over the last so many years. And then I can't wait to dig into your new research, which I think could really blow some of this out of the water and start to really reframe how we think about withdrawal strategies going forward.
Sure. Yeah, going way back, and this is now 30 years or more, I was a fledgling financial advisor, not a young one. I was 40 when I became a financial advisor, decided to start on a new career. I'm a baby boomer. My clients naturally were baby boomers, and back in the early 1990s, they were just starting to think seriously about retirement. And they were asking me questions like, well, how much do I have to save? I get to retirement, what kind of lifestyle can I have? What can I take out, each month? And also, how should I set up my investments during retirement, to sustain my lifestyle? And I started looking for answers, and I looked in all the places I could think of. The internet in the 1990s was not a very powerful research tool. So it was a matter of first going back to my books. Couldn't find any answers there from all my CFP courses. They didn't even mention the topic. I went to the library, looked through financial magazines, hardly anything covered there. And finally, I went to some of my fellow financial advisors in San Diego, who were an exceptionally bright bunch of people. But even they really couldn't offer any precise advice. They anywhere from 3% to 7%. Some of them said you got to have stock. Some of them said, no, don't invest in stocks, go all bonds. So I really got frustrated and confused. And I said, well, I'm not getting any answers. I got to forget it myself. So I sat down with a computer and a book of investment returns and inflation. And I just set out and said, let's try to get these answers myself. So in 94, I published my first paper. It was very, very limited. I was just basically looking at a situation where you have a tax-deferred account. And I asked the question, what is the highest return historically that you could get, or the highest withdrawal rate you could get with that in the worst case situation? And it turned out, the 1960s was a terrible time to retire into. And that gave me an answer of 4.15%, or about 4.2. And somewhere along the line, since that was one of the first papers, people got a hold of it and they rounded that down to 4%. And that was the 4% rule. That's how it came to be. I've done 30 years of research since then and, gone well beyond it. I think, if I still don't think the term rule is appropriate because if you look at history, retirees have been able to take anywhere from like 5% to about 14%, depending upon circumstances when they retire. But if we were to have a rule today and say it's a worst case situation, we're probably a lot closer to 5% than we are to 4%. Because I've made my research more sophisticated over time, added asset classes, looked at more efficient ways to withdraw the money. So we're getting up there. to a nice level.
That's a rewind moment there, Bill. So thank you for sharing your story. And I know it goes into more detail. The research you done at the time you did it, as you said, without the benefit of the World Wide Web that we had, and the depth that you went into, and the analysis that you did was mind blowing. To get these numbers, to actually create something that had a bit of a framework around it. So thank you for kind of doing that and really kicking off this, retirement income conversation all those years ago. The thing that really hit me when we spoke last week, before we, as we were kind of starting to talk about hitting record, is something you just said. You've had the benefit of 30 years of other research. You've got the benefit now of much more wider data sets and an understanding. And something that struck me when we first spoke, you said, actually, this is like now the 5% thing, right? Let's not call it the rule. This now is more like 5%. As a worst case scenario. You also shared with me that these worst case scenarios are quite interesting because there isn't many of them, are there? I think I just want you to share that bit with me, then we'll hop back to the 5% thing. But, when we say worst case scenario, I think you said there's only kind of one or two scenarios that existed that meant the 4% rule, or 1 or 2% of scenarios, the 4% number actually was the number. So, there's a lot of other scenarios where it could have been significantly more, right?
Absolutely. I work with now, I have about, in my database, 400 retirees, each retiring on the first date of quarter beginning January 1st, 1926. So I have almost 100 years, almost 400 retirees, and only
Wow.
one of them does that 5% withdrawal rate apply. That was the one who retired in October of 68. All the others, the other 399, have higher withdrawal rates, a lot of them much higher. To give you an example, for example, you would think that the person who retired, let's say in the year 2000, let's say July 2000, when the internet boom, all that stock bubble was going on, with very, very high stock valuations, would have had a very low withdrawal rate. It's lower than average. The average is 7, but for that retiree, I still compute that he's 5.5% would have seen him through, which is a lot higher than 5%. So, you can get some pretty bad conditions, still have higher withdrawal rates, because conditions in the late 60s were just unspeakably bad. It was one bear market after another, and then there's very high inflation, which drove up withdrawals. So it was a double whammy for retirees, and I haven't seen anything like that yet.
That is fascinating. 100 real life situations in your database, and only one of them run out of money taking 5% out, and on average 7% was what they could have done. We're going to get onto some scenarios in a bit, but I want you to share with the listeners, and just to let everyone know, this updated research is going to be done. Bill, you are publishing a book which I think will be the hottest ticket in town when it's released. So,
I hope so.
Be ready for that. So the book is going to be published, and I think there's no real title yet. You're working on it, but you're framing or putting everything together. But I'm fascinated in terms of the research that you've done over the last 30 years since publishing about the 4% withdrawal rate. That's caused this now to move as, again, a worst case scenario, 1 out of 400, but move up to 5. We talk about what you said, like the 4 free lunches, isn't there? To actually going, people can actually sustain a much higher withdrawal rate if they look at these 4 particular ways to invest and behave.
Yes, the first one is, of course, probably what almost all of us are aware of: diversification. You need to have multiple asset classes. You need to have foreign stocks, American stocks. You need to have some bonds in there, maybe some commodities, maybe some gold. The beauty of diversification, and this goes way back to the 50s, there was a Nobel Prize-winning paper done on this, is that different investments have different cycles of performance within the basic business cycle. So they reach their peaks and their valleys at different times. And when you put them together, they tend to amplify each other and increase the returns. For example, if you take a look at the 7 asset classes I'm using right now, and look at what you would expect to get out of for 1 year, you expect about an 8.5% return for 1 year, combining all the stocks. But when you actually run models for 30 or 40 years and you diversify with these assets, the average portfolio in my database earns 10% compounded annually.
Wow.
And that's diversification is a huge part of that. And that's if we didn't have that, we wouldn't be anywhere near 5% or even 4%. It's a very powerful tool. The second tool I'd like to talk to you about and mention is called glider path investing. This was a concept developed by two other advisors, friends of mine, Michael Kitces and Wade Fowle, and they took a look at a situation and they asked the question, most investors keep a static asset allocation, let's say 60-40. Well, what if we start out with a lower asset allocation and increase it gradually during retirement? And it turns out this adds a significant amount to your withdrawals, and it's kind of curious why that works. And part of the reason is that if you get a big bear market early in retirement, since you have a lower stock allocation than you might otherwise, it doesn't hurt you as much. Meanwhile, you're continuing now to feed money in to increase your allocation over the years, so you're buying stocks when they're cheap. And it has a very felicitous effect, and about 0.25% or more, depending upon the circumstances it adds. And that ain't chicken feed. The third one is to, instead of, let's say, stock asset classes, you could give 11% each one, or 12%, come out with a 60% for stocks. I found with my research it's better to slightly overweight the higher returning stock asset classes, which are typically small cap stocks and micro caps. If you slightly, don't go wild with this because you ruin it, but if you increase them slightly over the other ones, it will give you a significant increase in your withdrawal rate, comparable to what you got through the glider path. And these things add on, they compound. And the last one is very important for investors to remember is rebalancing of your portfolio. That will also add to your returns because it eliminates or reduces the possibility that you're going to get stuck in a big bear market with an over allocation to stocks. You got to just bring it, and rebalancing works beautifully. So those four things together, when you use them all, allow you to get to that 5% or maybe even a bit more in the future.
Fascinating, Bill. Can we touch on each one of them briefly? I think it would be really good to just touch on one, because the diversification one's interesting, because I think the original research that you didn't have that much diversification in the portfolio, right? I think it was
two asset classes.
Yeah.
That's right. And that I was trying to get a simple, quick result and find out, and it was instructive, but obviously no professional would manage a portfolio today with only two asset classes unless they were Nostradamus and they knew what was going to outperform. No one knows what's going to outperform when. So you need to keep all those in your portfolio all the time so that when the wind comes down through the channel, you're going to get the full benefit of the breeze.
Yeah. Is it fair to say, and to kind of buy the haystack, don't try and find the needle type thing? It's like, you want to own, quite a bit of everything. And also I think what's really key for me when I've looked at, your research and lots of other research, making sure that your portfolio is globally weighted in terms of you're not overexposed to areas that don't make up that much of the global GDP, right? So, for instance, over in the UK, there's a big weighting to the UK stocks, quite a big home bias. Now, the UK makes up you can between 4 and 5%, maybe up to 6% of global GDP, and stock market weighting. Yet portfolios in the UK will have 35% in UK stocks, and so. Conversely, with the US, that's about 60% of the global market cap. And people are going, the US is overvalued. I only want to hold 20% in the US. But we know that some of the best, if not the best companies in the world that will continue to innovate, make products, sell services, increase shareholder value, increase share price are going to be in the States. Diversification is wonderful, but be wary about where the market cap weighting is within the globe. Is that a fair assumption, a fair assessment, Bill?
Yeah, I think it's a fair statement. And, you just have to be careful not to chase performance too. And underweight asset classes that have been doing poorly. For example, for years, small caps and emerging market stocks have not done well. But if you take a look at what happened overnight in China with their strong reaction to their economy and what they've done, My emerging market fund is up 3% this morning,
Yeah.
and I'm glad I held on to it
Yeah. Isn't
because
that, yeah, yeah.
you could miss a day like that, and miss a lot of return.
Well, that's really fascinating, isn't it? Because our investment philosophy definitely does have a tilt and a weighting towards small cap value stocks that are typically the higher return areas, and they typically are quite what's the word I'm looking for? Quite concentrated and bulky in their returns. Returns are not they're not kind of smooth and ongoing. When that sector or that asset class comes in favor, you do get big kick ups in returns over a reasonably short period. And
Yeah.
the idea there is the key there is to be in them for when that happens, because that can give a bit of rocket fuel to the portfolio that's needed. You don't need consistent 6-7% a year. You might only have 3 or 4 for a number of years. Then you might get 21 year because small caps have taken off. That is
Yeah.
the kind of kicker that you need in the portfolio, right?
Absolutely. No, I'll have a chart in my book, which took me a month to create. And basically, I asked the question for each of my 400 retirees, what would have been the ideal asset allocation would have lasted them for 30 years, fixed allocation if they had perfect foresight and knew
Yeah.
which asset classes were going to do. And it's amazing to look at because those things shift dramatically.
Yeah.
You have for a couple of years, you may have small cap dominate. All of a sudden, international stocks come out of nowhere. They dominate for a few years, and then the next thing you know, it's American large cap stocks and this. Uh, if you could predict it, you
Oh,
could take out 8 or 9% without a problem.
yeah. Yeah.
That's how big an effect it is. But no one can do that.
No. No.
So diversification is our next best answer.
Glider path is really, and I've read about this. I'm a big fan of Michael Kitces and Wade Fowl is. I've had several conversations with Wade, and he's been on the podcast before. I love the work that
Uh-huh.
Wade does. Um, and I've read about the kind of what I think Michael Kitts has termed it as the reverse glide path, right? Because the normal glide path that retirees may go on if they have target date funds, etc., is that they actually reduce equities into bonds, right? But the reverse
Okay.
glide path is to have more fixed income and glide into equities, which is interesting because, and we're going to get into risk in a second, but one of the risks that is talked about, and you touched on this, is that the sequence of return risk. So if in the first few years of your retirement, the markets go against you, and for instance, your stock portfolio falls and you're drawing out of a stock portfolio, that can cause some problems for the longevity of the portfolio. And I think this is where that reverse glide path can take away one of the more risky scenarios that could happen to a retiree's journey.
Yeah, that's right. It's really an extraordinary effect. It's almost counterintuitive, but when you look at it, it's kind of funny, because when I was doing my research, I had worked with static allocation for a number of years, and then one day I said, let's see what happens when we try to reduce stock allocations, and that didn't work. That was terrible. Okay, and then I thought to myself, I wonder about if we increased asset allocation, and I thought for 5 seconds, I said, nah, that won't work.
No,
That's a lesson in humility in research.
yeah.
Never assume anything. But these two guys, I give them their credit. They said, let's explore this idea. They didn't. They come out with a winner.
Yeah,
And I think it's tremendously beneficial to
yeah,
retirees, the work they did.
yeah. And then lastly, just touching on the rebalancing, I think it's really interesting for me, for us working in this environment, rebalancing is, a staple of being able to make sure that portfolios sit there. And I think we often forget that, people that may be doing this themselves or people that are, that are retiring and have their portfolio to look at and manage, rebalancing is something that is actually more overlooked than what people think. People think it's a very intuitive thing. I want to make sure I rebalance my portfolio. But there's quite big danger to people that just invest and leave alone, right? And that is that if the stock market takes off and it does very well, your stock holdings, your equity holdings will naturally increase in terms of the weighting of your portfolio, which sounds okay until we get a bear market and you're now you could be 10-15% more exposed to the equity market when it falls than what you were. For anyone listening, rebalancing is so important. And I know you think from a time frame perspective, Bill, you're thinking kind of half yearly, yearly type thing?
Yeah, I think that turns out to be optimal. Believe it or not, it doesn't work in every single instance. I
No.
went and looked through all my 400 retirees, and for a few retirees, it was actually better off if you didn't rebalance.
Yeah.
But, they were the exception. They
Yeah.
had freak circumstances. In most cases, if you don't rebalancing, you're really courting trouble and looking to reduce your withdrawal rate. So, in general, I think 6 months to a year turns out to be optimal for 98% of retirees. I wouldn't recommend playing games with that.
No. Actually, our rebalancing philosophy is we do it in a drift basis. So we will allow for a 10% drift in allocation before we rebalance.
Okay.
Abraham Okinsanya, who runs Timeline, who I know you're friends with, Bill,
Yeah,
has
he's
got
a
some
good guy.
great research on rebalancing and what is optimal. And he's gone through all of this stuff. And it appears actually that having a tolerance-based rebalancing is really optimal, because what you end up doing is you're not trading all of the time. So you're not forced to trade every 6 months or year, which can add some cost into the portfolio. And the research suggests that actually 10% drift has no real meaningful impact on some of the downside risks there. And then, so if you've got an allocation of, say, 60% equities and it drifts up to 70, you're then going to sell stocks when they've done well and then reinvest back into bonds when they've probably been depressed. So you naturally do that kind of sell high, buy low mechanism when you do that rebalancing method, which I really like.
Beauty of diversification. It institutionalizes the idea of buy low, sell high. I know some pretty good investors. Somebody called Warren Buffett's done pretty well over the years using that philosophy. So
yeah. Honestly, Bill, fascinating. I want to touch on what we talked about in the glider path thing, and that is the kind of a couple of risks. So the sequence of return risk is something I think that many people who have probably Googled risks in retirement would come up. And obviously that is, as we said, the bad sequence early on in retirement. But your research has thrown up definitely a much higher risk event, and kind of pours a bit of cold water on sequence of return risk. It's maybe not as detrimental as to what we think it might be, but there is a particular scenario that I want to talk to you about at length, because I do think it's pretty poignant at the moment. And I do think it really does, when we put these plans in place and we look at worst case scenarios, this scenario is often the one that produces the worst case scenario in terms of running out of money really early. Bill, over to you. Tell me what that is and let's have a chat about it.
Yeah, I guess you could call it sequence of inflation risk.
Love that.
The particular withdrawal scheme I do most of my research with, it's not the only one, but I call it the COLA scheme, which is very much like Social Security, basically, where somewhere along the way you determine what your first year withdrawal is, and so Social Security based it on your past earnings. And then once you establish that, you simply give yourself a cost of living increase each year, which is comparable to what the prior year's inflation was. Well, when you're in a system where you're withdrawing every year and increasing withdrawals each year with inflation, if you run into a period of elevated inflation, your withdrawal is going to grow dramatically. And it's unlikely in our current environment we're going to have an extended period of deflation like we had in the 30s, where inflation was negative 10%. So once your withdrawals inflate, they're going to be stuck at that high level for the rest of your retirement. And that puts a lot of stress on unexpected stress on the portfolio, and they could do tremendous amount of damage. That's why I just say that retirement, for the retiree, the greatest enemy is high and extended inflation. And we hopefully our government officials will do everything they can to prevent that from happening.
I think we should touch on inflation and what it is. We talked last week, and we had a really good kind of 5-10 minute conversation about inflation and how people, I think, have it wrong and misinterpret it, particularly the public, right? You mentioned the deflation word.
Yeah.
Over in the UK, we did have stubbornly high, quite 11% inflation for a while. It's dropped off a little bit, dropped off quite considerably. People confuse falling inflation with deflation, right? So, just because inflation has moved from 11% down to 8%, things are still going up. They're just going up a little bit less aggressively than what they were doing beforehand. And as you said, if you get that spike in inflation, your base level now has gone up, and we're now kind of up here, and we're working to this kind of inflation level. So I think it's really important, and I'd love to get your take on that around how we can make sure that people understand inflation. And actually, if we want to get falling prices and we want to get cost of living to start coming down, we need periods of deflation, and we haven't had that for decades and decades.
Yeah, I think probably part of the reason is that central banks are genetically predisposed toward slight inflation, and they're fearful of deflation and the effects it might have on the economy. And they're probably right to a large extent. So as long as they control, the monetary effects in our global world, you probably won't see true deflation. If we do, it'll be a result of a catastrophe, which I hope never happens.
So it's interesting, when we spoke before hitting record today, some work that I've been doing for some clients over the last few days around stress testing their portfolios against these historical situations. I think all of the worst case scenarios in terms of the worst case level of sustainable spending that they could have made and the worst date they could have retired was kind of in the mid to late 60s. And for I wasn't alive then, I don't even think I was a twinkle in my mum's eye, to be honest with you, but I've read a lot about it. Bill, you went through it.
Yes.
Tell me about that period. What was going on in the mid to late 60s into the and actually kind of in the UK, it went through the 70s and into the early 80s. There was this kind of decade that really hurt people.
Well, I remember at that period of time, I was in my family's soft drink business back in New York. And, soft drink prices, early 60s and prior to that, were always very stable. You very rarely had to raise prices to the stores. But I remember when the late 60s and early 70s came along, and, sugar, we didn't have diet soft drinks then. Sugar was a very important component of soft drinks, and it was a commodity. It got to the point the price was rising so rapidly and so frequently that we were sending out price increase notices to our customers every 2 weeks. And before we do it, maybe once every 5 or 6 years. So it was really a bizarre and scary time. Everything was rising, and there didn't seem to be any way to stop it until finally Mr. Volcker and his Superman cape came along and did what had to be done and saved us all. But it's not something I would want to live through again, and certainly not that I'm retired. I don't even want to hear about inflation.
And I think you think of those events, right? Think of the oil crisis and what happened with kind of the oil industry during that period. You said sugar prices and coming out into the 80s. It really was in the UK, we had inflation at 18, 19%. Clients
scary.
that I talk to now went through that, and their mortgage payments and et cetera went through the roof, and a really challenging time. And I think, unfortunately, what has happened over the last kind of couple of years with inflation was such a shock to people, because prior to that, no one really, there was a whole generation that never experienced anything other than 2% inflation or zero inflation, right? And actually, I think become complacent and forgot how dramatic inflation can be, particularly into retirement. If you retired in the mid-80s, early 90s, the 2000s, you've had an amazing run at this. Amazing
as far
run.
As inflation goes, yes, absolutely.
Yeah. And so it's a slightly different world now. We've had that shock. Inflation, I think, is going to be probably a bit more persistent and a bit higher than what it has been previously. And so I think everybody needs to understand that it's a very different environment now when it comes to thinking about how to allocate and withdraw money for retirement.
I absolutely agree with that. You have to keep a very sharp eye out for inflation, and you can't control inflation yourself, but you can control what you spend. So that's probably the area we're going to be looking at to survive any future bursts of inflation, is to watch our spending. And that could be painful.
Do you have it? I mean, a lot of people I speak to here in the UK, there's a very different reality in terms of personal inflation and what CPI is. I'd love to hear, is that the same in the US? Your basket of goods definitely doesn't feel like it definitely feels like it's going up more than what it's suggesting is the headline inflation rate. So I think I personally, when I think about talking to clients and thinking about how they want to plan their retirement, I wouldn't look at what the CPI is or the headline inflation rate. What is your personal inflation rate?
Yeah, I think that's an excellent distinction to make. I know I track our expenses, and I honestly don't. If the government claims 2.9% inflation now, but personally, I'm higher than that. A lot of my friends are saying, "What?
Yeah.
I'm paid this much for that. Now I'm paying this much for that," and everything has gone up. So, yes, the reality can be a lot different than the reported figure.
And do you think that's why it's hugely important to make sure that you review your spending plans on a consistent basis, at least once a year, review what you're spending on so you can maybe restructure and make some slight adjustments to your spending? I think making slight adjustments along the way is better than making shock adjustments over longer periods.
Yeah, that actually anticipates I'm going to have 4 case studies in my book illustrating plans that appear to be getting into trouble. Because it's one thing to say I have a 5% withdrawal rate and starting retirement, but as retirement goes on, you want to review that. You want circumstances change. Inflation can be one of them. And the situation, I created a case study where there was a sudden extended burst of very high inflation, even worse than we had in the 1970s. And I demonstrated that, as your point, right on point, if you don't make adjustments early, and don't make them strongly in the face of inflation, you're headed for big trouble. Your plan is going to blow up very quickly because it compounds. While in another case where you just simply have a big stock market decline, even a 60% or early retirement, that'll eventually work its way through the system, the market will recover. You may not have to take any action at all with your portfolio and your withdrawal plan. But in the case of if you think inflation is going to go away and be high for 5, 6, 7 years, you're going to have to do something to survive. You're going to have to change the way you're doing things.
One of those interesting facts that is coming out of the studies out there now around how people actually spend their money in retirement has revealed that it appears as if spending in real terms actually does fall in retirement. So, it appears that we know that obviously we would spend potentially less in our 70s than we did in our 60s and less in our 80s than we did in our 70s as spending falls. And I think that's a really key distinction to make. It appears that spending falls in real term, but it doesn't mean that it's not going up with inflation, right? If inflation's at, say, 3%, it might mean that your real-time spending falls by about 1% a year, but it's still going up by 2%, if that makes sense. So, inflation is all around us, and I think is the number one threat and enemy to people living a happy and fulfilling retirement.
Yeah, it's kind of like that story about a 6-foot guy who drowned in a lake with an average depth of 5 feet. Averages don't mean anything. It's what the real figures are. I think it's different for every retiree. What I'm trying to do with my retirement spending is I'm following the COLA system. Maybe I just didn't get the memo. I haven't seen my expenses drop by 1% a year. But even if they didn't, what I'm trying to do is, as I age, is give more to my children in terms of bequests, so that the increased bequests offset any reduced expenditures I might have had in other areas. And I think a lot of people do that, so that it's an expense. The bequest is an expense, gift, and has to be treated as such. So I myself probably won't experience it, but I have seen the articles from respected authorities, and I say, okay, they probably know what they're talking about. That's probably true. I think it's still a very individual thing.
Yeah, I think it comes back to, I suppose, the point I probably didn't make very well there is it comes back to when there is high and persist or higher than normal and persistent inflation, this kind of all gets thrown out the window. I think people have been in normal over the last 30 years, potentially, maybe 20 years, that kind of real term spending fall is probably more realistic because we haven't had high. But when we've got a period of higher inflation and that cost of living increase is needed, you are going to experience much higher increased need to draw on the portfolio. And to me, that is the big event that many people need to be aware of and plan for, even if we believe the research is suggesting that things are falling over time. We need to, and I know you guys in the States have slightly or quite different healthcare cost needs than what we may do, but there's still that, you get that retirement spending smile, don't you, really, where it might be high at the start, but there is a real need to think about what it means in the future. And in the UK, care costs have their own inflation number. It isn't anything like the inflation number that the government suggests. It's typically a lot higher. So we might need to even think about protecting our money a little bit more to make sure that we're not a burden to our children or our family in the future, and we can afford the care and the health that we need in later life.
Yeah, that's a dilemma, and I think there was a survey recently done, I think in the United States, of people thinking about retirement, and they indicated 61% of potential retirees were more afraid of retirement than they were of death. And there's some of the reasons. We're talking about some very difficult adjustments that have to be made, possibly during a period of time where you have the least control over your income than you have any other time during your life. So it can be a little scary.
It's brilliant you said that. I've just been into South Africa, where we spoke last week and presenting, and I had that exact stat in my presentation. 61% of people are more fearful of running out of money in retirement than they are of dying itself. Which says where the foundation of our fears and behaviors are, right? Money is a lightning rod for emotions, and we can make pretty stupid decisions in the face of uncertainty. So having plans, I know it's not a 4% rule, but having rules and plans and maybe some really thought out strategies about how to deal with this is so important. So when we're faced with decisions in the face of uncertainty, we can make them from the most unemotional point we can make them from. I don't think they're ever going to be void of emotion, but we need to take as much emotion out of those decisions.
I agree. So you need good facts, you need good information, and sometimes you also need an objective third party to help you with that, because it may be too tough.
Yeah, absolutely. Bill, what are your kind of current observations then? If you had to summarize your last, say, 10, 15, 20 years of work that's culminated in you writing this long-awaited book that's going to summarize this with, from what you've told me, with amazing case studies, clear kind of graphs, etc. If you could summarize this now and how it might apply to people thinking of retiring now and what they're going to do over the next 10, 15, 20 years, could you do that for me?
Yeah, it's kind of an ironic situation. Let's take the time period 15 years ago was when the stock market bottomed out in 2009. I've been my work has been about getting the most out of your retirement portfolio, getting the highest withdrawal rate you can. Yet during the last 15 years, one of the most important factors for me in determining what you withdraw is stock market valuation. The higher the stock market valuation is, the lower your withdrawal rate. Over the last 15 years, we've faced with unusually high stock market valuations. So I've been studying an issue, trying to get beyond a 5% level, which really hasn't had much application for 15 years. I know the time will come when it will. There will be a time when the stock market will decline, you'll have better valuations, and then people can get more aggressive with the withdrawal rates. The problem is now is probably not it. I mean, I don't think this is the worst case scenario, but valuations are so high, inflation's a little higher than it was. It's literally off the charts. Historically, I don't have any period to compare this to that has a 30-year track record. When people ask me, under these circumstances of inflation and stock market valuation, what does your research say? It doesn't say anything. It's unique. We're creating our own track record here. So generally I say I don't think the situation is bad as to worry about just 5%, but 5.25%, 5.5% is probably the best you can do in this environment until we get more reasonable stock market valuations, and then we can take another look at it. But that's my situation. I've been basically working against the wind, I guess, hoping that the breeze subsides.
Yeah. Bill, this has been a fascinating conversation, and I can't thank you enough for taking your time to do this. I know you're off on your travels. You're going to speak at the Boggleheads conference to talk about this stuff. So I'm really looking forward to this getting out into the public domain a bit more. I cannot wait to read the work, the updated work, and read your book. And I kind of thank you for delving into the numbers for the benefit of all of us going forward and helping retirees to live a really happy retirement, but one they're comfortable with and one that they have some reassurance around.
Well, thank you. And this book won't be my last word on the subject. Every time I look at something new, I find something new I want to study and learn about, and I'm eager to share. So you'll be hearing me hopefully for a long time.
Absolutely, Bill. Bill, thank you so much. And what we'll do, I will have you back on once the book is out. I'll have a read of it, and then we'll get back on and we'll discuss some of those case studies and some of those numbers in there. I think that would be fascinating.
That'd be fun.
Awesome. Thank you, Bill. And that just leaves me to once again thank everybody for tuning in to the Humans versus Retirement podcast. Until next time, take care.
Thanks for having me, Dan.
Thank you, Bill.